Hey! Welcome back to the channel, where we're all about getting you on the road to financial freedom. Today we're talking about one of the most dangerous risks you might not have heard of, sequence of return risk. Sounds scary, right? Well, don't worry, we're going to break it down and show you how to protect your retirement from it. Spoiler alert, it's easier than you think. Before we dive in, make sure you hit that like button, subscribe if you haven't already, and share this video with your friends, because trust me, no one wants to find out about sequence of return risk the hard way. So let's get started. Alright, so let's start with the basics. What is sequence of return risk? Simply put, it's the risk that your investment returns in retirement will be unfavorable during the first few years of withdrawals. And why does this matter? Because the earlier you take money out of your retirement accounts during a market downturn, the harder it is to recover. Let's say you retire, and your portfolio takes a dive right away. Like, a big one. If you have to sell investments to fund your retirement lifestyle while they're down, you're essentially locking in those losses. Ouch! And the more years you have to deal with this, the more it hurts your long-term retirement plan. Think of it like this. If your portfolio is a roller coaster, you want to avoid being at the top during a sudden drop. We all know it's not fun, and in retirement, those drops can be even scarier because you're trying to rely on your investments to live. So why is this such a big deal? The timing of your returns matters way more in retirement than it ever did during your working years. Let me give you a quick example. Imagine you retire and start withdrawing from your retirement accounts in your first year of retirement. Now, if the stock market drops that first year, you might have to sell investments at a loss to get the money you need. But if you had waited just a few more years, you could have weathered the storm and let the market recover. Basically, bad returns early on can mess up your whole retirement. Like starting a marathon and tripping on the first step. You can keep going, but now you've got a nasty bruise, right? So now the question is, how do we protect against sequence of return risk? Well, we're going to break it down into some simple strategies that can save you from being stuck with an upside-down portfolio. The bucket strategy. Think of this as a way to create layers of protection around your money. Here's how it works. You divide your retirement savings into 3 buckets. Here's what each bucket does. Short-term bucket. This is your safety net, and it's all about cash or very low-risk investments. The idea is, you'll use this bucket to cover your expenses for the first 5-10 years of retirement. By doing this, you're not forced to sell stocks when the market's down. Instead, you're using cash to cover living expenses. This gives your investments time to recover. Mid-term bucket. This bucket holds investments that can grow over time but still have some stability. Think bonds or other fixed-income assets. These are your middle-of-the-road investments, safe but not as liquid as cash. You're still trying to grow this bucket for your future needs but without risking too much early on. Long-term bucket. This is your growth bucket. Think stocks or higher-risk investments. These investments will grow over time and fuel your retirement for the long haul. You're not going to touch this bucket for years, but when you do, it will be ready to provide growth. By using this 3-bucket strategy, you're able to avoid pulling from your growth bucket during a market crash, and instead rely on your short-term bucket while giving your long-term bucket time to recover. It's like having a cushion under your pillow while you sleep. No worries. Reduce your withdrawal rates. I know, we all want to live it up in retirement, but if you're withdrawing too much too early, you run the risk of draining your portfolio before it can recover. Financial experts often recommend starting with a 4% withdrawal rate, meaning you withdraw 4% of your total portfolio each year. This has been shown to help your money last longer. If you're withdrawing at a higher rate, you could end up depleting your funds faster than expected, especially if your investments take a hit early on. It's like having a big bowl of ice cream. You want to enjoy it, but you don't want to finish it all in one sitting. Slow and steady, folks. Laddered bonds. This is another way to create more stability. Here's the deal. Bonds are often seen as a safer option compared to stocks. But instead of buying just a few bonds with long maturity dates, you build a bond ladder. This means buying bonds that mature at different intervals, say 1 year, 3 year, 5 year, etc. Why is this helpful? Well, if you rely on bonds that mature at different times, you have constant access to funds without having to sell any at a loss. If one bond matures and you're still in a market dip, you can use those funds to support your lifestyle and let the longer-term bonds keep working for you. Diversify, diversify, diversify. Yes, it's that simple. The more diversified your investments, the better chance you have of riding out rough patches in the market. So mix up your portfolio with stocks, bonds, real estate, maybe even a little bit of cash. It's like not putting all your eggs in one basket. In fact, let's just say it's like having a dozen baskets. You'll still have eggs left if one basket gets smashed. Plus, diversification helps to smooth out those ups and downs in the market. So, who needs to worry about sequence of return risk? Well, everyone should be aware of it, but it's especially important if you're near retirement or already retired. If you're young and have decades to go, you've got time on your side. But if you're pulling from your retirement savings, that's when the timing of your returns really counts. So, if you're planning to retire soon, or you've already taken the plunge, you'll want to make sure you're prepared for this risk. So there you have it, folks. Protecting your retirement from sequence of return risk doesn't have to be complicated, but it's something you definitely want to be aware of. Use these strategies, and you'll be in a much better position to retire with confidence, no matter what the market throws at you. If you found this video helpful, don't forget to hit that like button, subscribe to the channel for more content like this, and share this video with someone who might need a little help planning for a secure retirement. Thanks for watching, and I'll see you in the next one, where we're going to dive into even more ways to protect your nest egg. Take care, everyone.